There's a day in July 1997 when one country's surrender triggered the collapse of 5 nations. July 2nd, 1997. Bangkok, Thailand. The Bank of Thailand had been fighting for months, defending their currency, the baht, pegged to the US dollar since 1984, 25 baht to $1. Fixed and stable for 13 years, but in 1997, hedge funds attacked, led by George Soros. They borrowed billions of baht, sold them for dollars, and bet the peg would break. The Bank of Thailand fought back, buying baht, selling dollars from their reserves, trying to hold the line at 25 to 1. They spent $2 billion per day for months, but on July 2nd, 1997, they ran out of reserves, out of options. They announced, "Thailand will float the baht." Translation, we surrender. The peg broke. Within hours, the baht crashed 20%, from 25 to 30 to the dollar, then 35, then 40, eventually 56 to 1. A 55% collapse in 6 months. Thai companies that had borrowed in dollars suddenly owed twice as much in baht. Bankruptcies cascaded. Banks collapsed. The stock market crashed by 75%. But Thailand was just the beginning. Indonesia, Malaysia, the Philippines, South Korea all had the same problem. Currency pegs they couldn't defend and dollar debt they couldn't repay. By the end of 1997, 5 countries were in crisis. $600 billion in wealth destroyed. Millions unemployed. Governments overthrown. All because of one structural flaw: currency pegs. Every currency crisis begins with a promise to maintain a fixed exchange rate, no matter what. In 1984, Thailand decided to peg the baht to the US dollar. 25 baht equals $1 US. Fixed. This made sense at the time. Thailand was a developing economy, and exports were crucial. A stable exchange rate meant that foreign companies could invest without currency risk. Thai exporters could plan ahead, knowing the rate wouldn't change. Dollar loans were cheap because the peg eliminated currency risk. For 13 years, the peg held. Thailand boomed. GDP growth averaged 8 to 9% per year. Bangkok became a financial hub. Foreign investment poured in. Thailand became one of the Asian tiger economies. But the peg created a hidden vulnerability. To maintain a peg, a central bank needs reserves. Dollars. Lots of them. If the market wants to sell baht, the Bank of Thailand must buy baht to support the price. But to buy baht, they need to sell dollars from their reserves. As long as they have enough dollar reserves, they can defend the peg. If they run out, the peg breaks. By 1996, Thailand had a problem. The economy was slowing. Export growth was declining. But Thai companies had borrowed heavily in dollars. $90 billion in foreign debt, much of it short-term. Banks had borrowed dollars cheaply because of the peg and lent baht to real estate developers. This created a mismatch. Banks owed dollars, but their assets were in baht. If the peg broke, they'd need more baht to buy the dollars they owed. Bankruptcy. By early 1997, the Bank of Thailand's reserves were falling from $38 billion in 1996 to $30 billion by May 1997. They were spending reserves to defend the peg, but the outflow was accelerating. That's stage 1. When you promise a fixed exchange rate, but your economy is weakening, your reserves are draining, and your debt is rising, the peg becomes a target. Stage 2 is when traders realize the peg can't hold, and they bet against it. By early 1997, several warning signs were flashing. Reserves draining from $38 billion to $30 billion. Current account deficit at 8% of GDP. Meaning Thailand was importing far more than it was exporting. $90 billion in dollars owed, but only $30 billion in reserves. Real estate prices that had tripled, financed by dollar loans. George Soros saw these signs. He'd done this before. In 1992, he broke the Bank of England, forced Britain out of the European exchange rate mechanism, and made $1 billion in profit in one day. The playbook was simple. Find a country with an unsustainable peg, borrow massive amounts of their currency, sell it for dollars, Wait for the peg to break. Buy back the currency at the lower rate. Repay the loan and keep the difference. In May 1997, Soros started attacking the baht. His quantum fund borrowed billions of baht and sold them for dollars. Other hedge funds followed with billions more. The Bank of Thailand responded by buying baht to support the price. But this meant reserves were falling faster, from $30 billion in May to $28 billion by mid-June. The market could see it. Every day, the Bank of Thailand published reserve figures. Everyone knew they were running out. This created a self-fulfilling prophecy. The more they defended, the faster reserves fell. The faster reserves fell, the more traders bet against them. The more traders bet against them, the more reserves they had to spend. A death spiral. By late June, everyone knew Thailand would lose. The only question was, when? That's stage 2. When the market sees that you can't defend the peg. When every defense drains your resources. When traders can't lose. If the peg holds, they lose a little in interest costs. If it breaks, they make fortunes. Stage 3 is the break itself, when the promise shatters. On June 30th, 1997, a crisis meeting. Thai finance minister, central bank governor, and IMF officials. The choice was clear. Continue defending and run out of reserves completely, or surrender now and float the currency. If they ran out of reserves entirely, Thailand would have $0. Couldn't import oil, food, or medicine. Total economic collapse. Better to float while they still had some reserves left. On July 2nd, 1997, at 9 a.m. Bangkok time, the Bank of Thailand announced, effective immediately, Thailand will adopt a managed float for the baht. Translation: the peg is dead. Within minutes, the baht crashed, from 25 to 28 to the dollar, then 30. By the end of the day, 29 to 1, a 16% crash in one day. But it didn't stop there. July 3rd, 31 to 1. July 10th, 32 to 1. August, 35 to 1. By January 1998, 56 to 1. From 25 to 56 in 6 months. A 55% collapse. What this meant for Thailand. Thai companies that owed $100 million in dollar debt. At 25 to 1, that was 2.5 billion baht. At 56 to 1, that was 5.6 billion baht. The debt more than doubled in baht terms. Many companies couldn't pay. Bankruptcies cascaded. 56 of 58 Thai finance companies went bankrupt. The stock market fell 75% from peak to trough. GDP contracted 10% in 1998, the worst recession since World War II. The speculators made fortunes. Soros's quantum fund profit, estimated $750 million to $1 billion. Was this immoral? Soros argued no. I didn't cause the crisis. The peg was unsustainable. I just recognized it before others. Critics said he attacked a developing country and caused massive suffering for profit. The debate continues, but economically, Soros was right about one thing. The peg was unsustainable. $90 billion in debt, $30 billion in reserves. The math didn't work. The peg would have broken eventually. Soros just accelerated it. That's stage 3. When the promise becomes impossible, reality catches up to fiction. Stage 4 is the contagion. When one country's crisis becomes everyone's crisis. When Thailand's baht broke, investors panicked. If Thailand can't maintain its peg, who else can't? They looked at Thailand's neighbors. Indonesia, Malaysia, the Philippines, South Korea. All had similar vulnerabilities. Currency pegs, or managed exchange rates, heavy dollar borrowing, weakening economies, and draining reserves. Investors started pulling money out. Everywhere. Indonesia, July to December 1997. The rupiah was managed against the dollar. When Thailand fell, investors fled Indonesia. The rupiah crashed from 2,400 to 16,000 to the dollar, an 85% collapse. Indonesian companies with dollar debt went bankrupt en masse. Banks collapsed. Riots broke out. President Suharto was forced to resign after 32 years in power. Malaysia, July to September 1997. The ringgit fell from 2.5 to 4.7 to the dollar, a 47% collapse. Prime Minister Mahathir blamed rogue speculators, specifically Soros. He imposed capital controls to stop money from leaving the country. This worked partially, but damaged Malaysia's reputation. The Philippines, July to October 1997. The peso fell from 26 to 45 to the dollar, a 42% collapse. The Philippines had less dollar debt than Thailand, so the crisis was less severe, but still painful. South Korea, October 1997 to January 1998. South Korea seemed stronger, the 11th largest economy in the world. Major corporations, Samsung, Hyundai, LG. But Korean companies had borrowed heavily in dollars, short-term debt. When the crisis spread, foreign banks refused to roll over loans. South Korea faced default. The won fell from 900 to 1,900 to the dollar, a 53% collapse. The IMF provided a $58 billion bailout, the largest in history at that time. By December 1997, 5 countries were in crisis. $600 billion in stock market wealth destroyed. Currencies down 40 to 85%. Millions unemployed. Governments falling. All triggered by Thailand. That's stage 4. When one country's collapse triggers panic. When capital flight becomes a stampede. When fear spreads faster than reason. Stage 5 is the aftermath. When the crisis ends, but the scars remain. The IMF arrived with bailouts. Thailand, $17 billion. Indonesia, $43 billion. South Korea, $58 billion. But the conditions were brutal. Raise interest rates to defend the currency. Cut government spending. Close insolvent banks. Open markets to foreign ownership. These conditions were designed to restore confidence. Instead, they deepened the crisis. Higher interest rates crushed businesses that were already struggling. Government spending cuts reduced demand when demand was already collapsing. Bank closures triggered more panic. Critics called it IMF austerity, making sick economies take medicine that made them sicker. The human cost was staggering. Thailand, GDP contracted 10% in 1998. Indonesia, GDP contracted 13% in 1998. The worst in modern history. South Korea, GDP contracted 5.5% in 1998. Across the region, 24 million people fell into poverty. Suicide rates spiked, political instability followed. Indonesia's Suharto resigned after 32 years in power. Thailand changed governments. South Korea elected a new president. Recovery took years. Thailand didn't return to 1996 GDP levels until 2002. Indonesia took even longer. The Asian tiger miracle was shattered, but the pattern was established. Currency pegs create vulnerability. Speculators exploit that vulnerability. Central banks run out of reserves. Pegs break. Contagion spreads, and the pattern keeps repeating. That's stage 5. When the immediate crisis ends, but the structural lesson remains. Currency pegs are promises, and promises without sufficient reserves are just words. The Asian crisis pattern has repeated multiple times. Turkey, 2018 to 2023. Stage 1. Turkey didn't have a hard peg, but the central bank tried to manage the lira's value. Turkish companies borrowed $450 billion in foreign currency debt. Stage 2. By 2017, problems emerged. Current account deficit at 6% of GDP. Inflation rising to 12%. President Erdogan refused to raise interest rates, calling them the mother and father of all evil. Stage 3. In August 2018, the attack intensified. Political tensions with the U.S. Trump imposed sanctions. Investors panicked and sold Lira. Stage 4. The Lira crashed from 4.9 to 7 to the dollar in August 2018 alone. By 2021, 18 to the dollar. By 2023, 28 to the dollar. An 82% collapse in 5 years. Stage 5. Turkish companies with dollar debt went bankrupt. Inflation hit 85% in 2022. Living standards collapsed. Argentina, perpetual crisis. Argentina has had currency crises in 1975, 1982, 1989, 2001, 2018, and 2023. Every time, same pattern. Currency peg, dollar debt, reserves drain, peg breaks, crisis, IMF bailout. Repeat. In 2023, inflation hit 211%. Javier Milei was elected president on a platform to abolish the peso and adopt US dollars because Argentina has proven it can't manage its own currency. Egypt, recent years, Egypt has devalued the pound multiple times since 2022. March 2022, 15% devaluation. January 2023, 15% devaluation. March 2024, 40% devaluation. Each time, the government promised it would be the last. Each time, they were wrong. The pattern is identical. Thailand 1997, Turkey 2018, Argentina 2023, Egypt 2024. Currency pegs create targets. Speculators attack targets. Central banks run out of ammunition. Pegs break every time. If you've watched this far, you understand the currency attack cycle. You see how Thailand in 1997 and Turkey in 2018 followed the exact same 5 stages. Subscribe to Capital Origins. Because when the next emerging market currency comes under attack, when the next country promises to defend a peg it can't afford, you'll want to know which stage we're in and whether the peg will hold or break. Currency pegs create vulnerability. Speculators exploit that vulnerability. Central banks run out of reserves, and the peg always breaks. Hit subscribe, because the Asian financial crisis happened over 2 decades ago, but the pattern repeats every decade. Turkey, Argentina, Egypt. The next crisis is forming somewhere. You just need to recognize the warning signs before the reserves run out, before the peg breaks, and before your savings are cut in half.